It's looking pretty likely at this point we're going to see limits for ISAs, in particular cash ISAs, cut to £4,000 or £5,000, down from £20,000 in the next week or so. That's a huge deal if you've got savings. It could mean more tax, less interest, and fewer safe havens for your money. It's been something that's been bubbling for quite some time. There's been a ton of rumours flying around about what they would or wouldn't do with this. I've seen so many videos made about this. I've seen some TikTokers make over 20 videos about this limit change before anything's actually happened. And rightly so, it's scaring a lot of people to death. Martin Lewis has also been recently sharing his opinion quite heavily. Now it's looking like it's more likely to happen. He's called it a mistake and peed people off economics. In fact, it's rumoured to be on the 15th of July at a Mansion House speech, but if not then, it may very likely come soon after, as it hasn't been ruled out. If it does go ahead, the actual implementation would come in the autumn budget. So I want to take a minute to discuss this change they are possibly making and what you can do about it, because it's actually far easier than you might think, and there's definitely no need to panic. Even if you don't use cash ISAs in particular, I think your input on this is really important to share this information with others, and it's a really good opportunity to talk about this in general because it is a huge issue. Now, what's actually happening with it, and why on earth would they want to change this limit? Well, in a nutshell, they want more people investing in a couple of ways. So they want to drive growth in the UK economy, growing our economy. One way of doing that is having more people investing in the stock market. That would trickle into the UK in a couple of ways. It could be that they buy UK stocks or government bonds, or it could be that they buy a fund or ETF, which has a certain percentage allocated into the UK economy anyway. Like anything, this does come with positives and negatives, so let's start on a positive note. The first positive is the UK would benefit from having more money into the economy, rather than it just sitting in cash. And I believe that the people who did this correctly and were encouraged to invest their money rather than just having it sitting in a cash ISA would do better. If we look at this chart, for example, from Vanguard, this shows the returns of having your money in cash versus having it in the stock market. Now on the surface, this chart looks simple. Surely stocks are the clear winner. But it actually looks here that this is just cash in the bank, but it's really not. If we were to add inflation into this calculation, the amount in your cash with no interest would be in real spending power because money's worth less is right down here. So that shows us, if you're having your money in a cash ISA, the return just about holds with the value of our money, which is pretty crazy. Imagine what happens when those rates are low. But also here, it looks like stocks are the clear winner, but they actually aren't always. So if we look at these two periods highlighted here, you can see actually if you wanted your cash out in those periods, the stock market was down. They are particularly bad crashes in stock market history, but it shows you that short-term stocks don't always win. That's why I always say if you have 3 to 5 years plus to wait stocks, if you need the money sooner, then go for cash. The issue is people are so terrified of the stock market, the general perception of the stock market is that it's risky and people don't want to take a risk, when in actual fact they're losing out because of something called opportunity cost. And every time I speak to people, this is a problem I see over and over again. If we look at, say, the Vanguard FTSE All World Fund, here's a performance over the last 5 years. Pretty incredible. Even taking into account this year here, that's an average of 11.09% per year. Your chances of getting that in a cash ISA are very slim. I mean, if they did offer it, it would be a major red flag. The reason they don't is because typically it's based on the bank rate. So the bank rate right now is 4.25% in the UK. So what will happen on any cash you have in your account, the bank will get 4.25% on it, and they will pay you maybe 4% and they'll profit the 0.25%, give or take, depending on what they offer you. Now, in no way can you look at our stock market performance and think it's normal because it has been incredible. But over the long run, over a 30-year period, the S&P 500 has returned about 10% per year on average. And the all world, which is thought to be a bit safer, around 8%. Even looking at one of my own accounts, this is one of the most recent accounts I opened. The top is money in a cash fund, getting around 4 to 5%. The two below are the stock market, and in the same time period returned 12% and 10%. Again, that's not guaranteed, it's just how the market has fallen. But it's a no-brainer to go for the market versus cash, as the money's in there for another 20 years at least for me. So when you look at it like that, it would be a very positive thing to encourage people who just leave their money in a cash ISA, or even worse in a savings account, getting peanuts, to think about investing their money for long-term growth. The amount of people I see missing out on tens of thousands, even 100,000 plus in their lifetime is crazy, and it's actually very common. So pushing people towards investing, I think, is actually more positive than people would realize. Now, let's talk about why it's not so good. Well, honestly, because people haven't really got a clue. But it's not their fault. We weren't taught how to do any of this stuff in school. It seems so daunting and scary and really risky. I mean, who can blame them for not wanting to invest? And coupled with that, it's like a bull in a china shop and could push people the wrong way and pick the wrong type of investments very quickly. Poor performing investment funds, overpriced financial advisors, or robo-advisors which underperform the market too, especially if there is an emphasis towards UK-based companies which in the past haven't performed anywhere near as well as global ones. The reality is, however, which I think is more likely, is people still won't invest. Some will, sure, but some will find it far too risky because they don't get it. And the money will just fall into regular savings accounts, which means, dun dun dun, more tax for the government, because savings rates have been hammered recently. And by that I mean the amount you can earn from interest before paying tax on it. Yep, another tax on the money you've already paid tax on before you pay tax on it. Again, I mean, who could make this stuff up? You've only got £1,000 as a basic rate taxpayer, £500 as a high rate, an additional rate, well, you can forget about it. Anything over that, you're going to be taxed as if it's income. So it's no doubt they will end up getting more money from it. I think judging by people's comments on this is also a big misunderstanding about how this would actually work, because it's not really touching the £20,000 ISA limit at all, it's just repositioning it. So at the moment you've got this £20,000 personal umbrella of how much you can add into an ISA each year. That can be made up of £20,000 in a cash ISA, £20,000 in a stocks and shares ISA, £4,000 in a lifetime ISA, and £4,000 again in an innovative finance ISA, which I wouldn't touch. Now, all that would change is that £20,000 coming from cash would be limited to £4,000. You'd essentially put 4k in cash, and the remaining 16,000 would be put into shares or lifetime ISA if you can make use of it for retirement or a house. So the actual top level umbrella wouldn't change. It also wouldn't affect any previous cash ISA holdings you hold. So if you had £100,000 in a cash ISA, they wouldn't force you to take out £96,000. They would only let you put £4,000 more into what you already had per year. Both of them are quite common misconceptions people talk about a lot. But the truth is, it's actually quite easy to get around, and it's much easier than people think. So it wouldn't bother me in the slightest, and here's exactly how I would do it. Now, one honourable mention before I start is you could use premium bonds. Premium bonds are a saving product from NS&I, which is a government-backed savings body. Instead of earning guaranteed interest, your money goes into a monthly prize draw. Each £1 bond is an entry, and you can hold up to £50,000, and there's no risk of losing your original money. It's fully backed by the UK Treasury. Now, as of mid-2025, the prize fund rate is 3.6%, which is down from over 4% last year. This rate is the average return spread across all bond holders, if you're very lucky and you hold the maximum amount for long enough. But crucially, most people won't get exactly 3.6% a year. It's kind of like a lottery. You might win nothing for months or hit a bigger prize. If you hold the maximum, which is £50,000, your median expected return is estimated to be around 3.3%, not the headline 3.6%. Because of the way the prizes are distributed. With smaller amounts, say £500 to £1,000, returns are very uneven. You might win nothing at all for very long periods of time. Premium bonds are typically best if you can put in a larger amount, closer to the £50,000 limit. That way you smooth out the randomness and get closer to an average return. Personally, I've used premium bonds for a while saving for a house. I wanted a place to park the deposit short term with zero risk of losing my money. I'd already used my ISA limit and I didn't want to end up paying tax because all winnings are tax free. But if you're only saving small sums, it's actually less reliable. I actually, even with the maxed, did underperform a fixed rate. Now, I know what you're thinking, well, Chris, that's no good, but I just wanted to mention these because people will recommend them, and they do have a use case for cash. But in actual fact, what I would do is one of these two things instead. First, as you saw in my portfolio that popped up earlier, I have this thing, the Amundi Smart Overnight Return. This is something called a money market fund. These invest in short-term government debt and other fixed income securities backed by excellent credit ratings. They're aligned to something called the overnight rate. This is a rate of interest only offered to the largest, most secured financial institutions like banks. All you need to know is you invest in a good quality money market fund and your money goes up at a fixed rate. There's a few on InvestEngine. This is the one I like, which is the one that's most popular. It has around 3.5 billion in it. And as you can see over the 1-year view, it's gone up 5.2%. That will change as it's just an average, so take that with a pinch of salt, but aims to be as high as possible. I use these all the time within my stocks and shares ISA, and with ISAs being flexible now, meaning you can take money in and out without affecting your allowance, this is a really nice option. So essentially, all you need to do is open an account, deposit your money and buy this, and you're done. These are classed as very low risk, perhaps not as low risk as leaving the money in the bank, but they are classed as low risk providing you use the right platform and pick the right funds, which is easier than you think. InvestEngine also has a welcome bonus of up to £100 when you sign up, which I'll pop down below along with a few other links. Now another option, perhaps even easier again, but not one that I do, is to open with a platform that pays you interest on uninvested cash. InvestEngine don't do this as they're more geared toward you actually putting the cash to use, i.e. investing it or putting it in a money market fund, but it is a very viable option. Trading 212, for example, will currently pay you 4.35% on any uninvested cash. You do need to opt into this, and it's also using a money market fund. You can see this here in my account. I've not got as much cash as I don't tend to keep a lot in here, but I'm getting 37p a day, getting 4.35%, and I've made £6 over time. You could just deposit money in here and you would get interest in that way. It's actually exactly the same, just in a different wrapper. I actually prefer the InvestEngine way as I have more control over which money market fund I'm using compared to Trading 212, but sign up and have a look at both. Trading 212 also gives you a free share too, so I'd also look at that. As a side note, another platform is Lightyear, who also do this in their cash vaults. But please note that all of these savings use money market funds, which are investments, so your capital is at risk. They slightly tip Trading 212 at 4.36%, and hey, every penny counts, right? So it's also a really nice platform, and I'd have a look at that one too, and there's also a bonus link for that one, which I'll pop down below. It's all about what you like and what works best for you, but the bottom line is, all you need to do is put your money in a stocks and shares ISA instead. However, getting that across to everyone isn't quite as easy. So if and when this change does come, if you could try and help anyone you know when this does happen, so they aren't scared to death, just within our own community here, maybe it will create a ripple effect and will get this message out to more people. Maybe just send them this video. I've also got really in-depth guides on picking the right kind of account and how to invest without being terrified of the stock market, which they can check out too. As I say, it's important we know this change it may or may not come. It's not been confirmed or set in stone, but it is looking likely. And if it does, no dramas, as we can easily use one of these workarounds instead. We just need to make sure that everybody else does too, which is the hard part. But I hope this was helpful, and I will catch you guys in the next one. Thanks.